We're entering a new era of higher inflation, predicts Grant Williams, which means that the rules of investing have just changed. As a result, the investments that have performed well over the past several decades may do poorly going forward in this inflationary future. So what's Grant's advice to today's concerned investor? To find out, keep watching this video. Oh, and as always, please take a second and click the like button below to help us continue the run of amazing guest experts that we've had on this program. The more clicks these videos get, the more big names we're able to attract. And now let's get started watching this week's market update featuring Grant Williams. Hi everybody, Adam Taggart, co-founder of Peak Prosperity here, welcoming you back to another week of trying to make sense of these markets. This week we have a very special guest. It is Grant Williams. Now, Grant spoke at our recent How to Prosper in the Post-COVID Future seminar that Peak Prosperity just held a couple weeks back, which was an amazing event. And Grant's speech was so great that we are bringing it in large part to you today. Grant, if you're unfamiliar with him, he's really one of the best in the business. He's spent 30 years in the financial industry. He's one of the most extremely respected financial commentators today. He produces the Things That Make You Go newsletter, and he's a co-founder of the financial interview series Real Vision. Without further ado, let's get started here with Grant. Real quickly though, before I play the interview, I just want to let you all know that as usual, we're here with the lead partners from New Harbor Financial, and after Grant's video plays, I'll spend the rest of the time talking with John and Mike about what's happened in the markets since our last video last week. And without further ado, here's Grant. I'm actually going to read my first question for you, if you don't mind, just because I just think you're the perfect person to address this question.
Well, let's see if I don't let you down.
All right, great. There were many observers, including you and us at Peak Prosperity and many others, who were concerned about the everything bubble blown by rampant central bank intervention over the past decade. And then 2020 arrived with the coronavirus and its massive blow to the global economy, which then triggered many trillions more in both monetary and fiscal stimulus around the world. The end result? Financial assets at all-time highs, while economic growth has been deeply, historically negative for much of this year. Here's the question, Grant. How much worse has 2020 made the situation?
Well, I mean, look, you can see and feel it. I think feeling it is probably the most painful thing to people, because what's happened is prior to this pandemic, it was really only people paying attention to financial markets who either felt that something was wrong, felt what was out of whack, and people who weren't really paying attention but just had watched their 401ks go up were completely oblivious to it. I think what the pandemic has done has made everybody aware that things aren't right. And for many people, the things that aren't right are going to be very local to them. It's going to be their job, their rent, their kids. It's that kind of stuff. But to those of us who've been following this everything bubble as it's inflated, I think we realize that this is an accelerant. This is not the problem. COVID is not the issue here. COVID has accelerated the time frame along which this thing's going to unfold. So I think the desperation of the measures currently being employed by central banks and governments tell you how bad this thing is. I mean, we're not adding stuff in the billions anymore. We're on to trillions already. This word stimulus keeps getting thrown around. And really speaking, this is not stimulus anymore. This is maintenance. This money that's being thrown at this problem is not stimulating anything. It's holding things together. And without a couple of trillion here and a couple of trillion there, this whole thing would be in tatters on the floor. So what's happened is the governments have continued to print money that they don't have. The UK has just announced that they're going to pay 60% of salaries until May, which they don't have that money, but they don't feel like they have an option. So all these measures that are being thrown at this are just a sign of the desperation. So has it exacerbated the problem? I don't think necessarily it's exacerbated it. It's just sped the thing up, and it's made it a lot more real to a lot more people who otherwise weren't paying attention.
Okay, so that cracks open a whole host of other questions, but I guess let me ask this one first. What are the limits, if any, of more stimulus? Both in terms of, is there an absolute level of stimulus above which, they really can't print more without just cracking everything, or are we just going to find that out? Nobody knows, and we're just going to hit that blindly. And then secondly, is there a way here for the powers that be, the central banks, the governments, et cetera, to paper over the tremendous blows the economy have taken and get us to sort of the other end of this with an intact economy that can grow again in the way that we need it to? Or are we just, you call this maintenance, but it's just basically just sort of, treading water for as long as you can before you sink beneath the surface?
Well, we've been in a cycle where the hope has been that economic growth will return, and QE is just going to keep things ticking over until economic growth returns, which is ultimately really one of the only ways out of the debt problem that they have. That clearly hasn't happened if you look at global GDP growth for the last decade, ever since the global financial crisis. So at this point, really, the limitation on the amount of stimulus that's being applied to the situation is actually very simple. It's just confidence. It's confidence. If people continue to believe that this stimulus will solve the problem, they continue to believe that the Federal Reserve have things under control, the government can print money and it'll all be fine, then this could go on for a while. But once that expanded money supply and the extra that's being created starts to lose its purchasing power over the short term, rather than gradually as the dollar has done since 1971, then it becomes a problem. So that means that the big bugbear here is inflation. And it hasn't been something we've had to worry about for 40 years now. I mean, it's a long time to be in a one-way trend, essentially. If you look at a chart of the yield on the 10-year Treasury, it's a perfect downward line. But within that, as you look at it, you'll see these big spikes all the way down. And each one of those was some kind of scare, whether it was an inflationary scare or a scare about the sanctity of the financial system or the ability of the powers that be to hold this thing together. Each one has been a scare. Now, if we do get inflation, which more and more very seasoned observers are starting to really worry about for the first time in a long time, that changes everything. So, as more and more very smart guys have been starting to fear over these last few months that inflation is going to come back. And I'll talk a little bit about some personal conversations that I've had with that regard. So, I do a podcast with a friend of mine, Bill Fleckenstein, called The End Game. And in that, we were very fortunate to interview back-to-back Russell Napier and Lacey Hunt. And Russell came first. And Russell's been a hardcore deflationist for 20 years now, and he writes incredibly eloquently on the subject. He basically said he believes that is done, and we are now in an inflationary environment to the point where he expects inflation. We had this conversation a couple of months ago now. He expects inflation to be pushing 4% by the end of this calendar year, which is a dramatic change.
Whoa, yeah.
Yeah, exactly right. Now, the following week, we interviewed Lacey Hunt, and Lacey has been, similar to Russell, has been a deflationist, and Lacey's been a deflationist for 40 years now. He's stayed on that train no matter what anybody's come along and said, and his rationale behind that is out there in the public domain. And if anyone wants to read any of Lacey's stuff, it's been incredibly consistent, and he's been right. It may have been the trade of a lifetime, and he's stuck with it for 40 years. And so we asked Lacey, we've got smart people who, like you, were in the deflation camp, who are now not only getting nervous, but actively switching to believe that inflation is in our future. Where do you stand with that? And he remained absolutely adamant that he didn't see inflation as a problem. He was still absolutely firm in his belief that deflation was going to continue. But he made one caveat. And that was, he said that if the Federal Reserve start to monetize the assets on their balance sheet outright, then he would very quickly change. And literally 24 hours after we recorded this interview, an article came out talking about the Fed distributing digital dollars based on their assets to Americans. They're going to have this Fed account, and they will be able to deposit digital dollars into people's accounts backed by their assets. So that clearly tells you, that's a trial balloon. We've seen dozens, if not scores of them over the last 10 years. This is on the mind of these guys as the next potential step to literally drop helicopter money into people's bank accounts. And when you have someone like Lacey saying that that's the thing that would make him abandon a trade he's been right on for 40 years, you have to really start thinking about it. And so as that podcast series has gone on and we've had more of these conversations, inflation has been one of the key things that we've discussed with people. And it feels to me personally that it is time to, at the very least, take inflation seriously as a potential threat for the first time in many people's careers, if not lifetimes. And what that does, if you decide that we need to think about inflation as a problem, there is hardly a portfolio in the world that is set up correctly for an inflationary environment, because they haven't needed to be for 4 decades. So suddenly you have to think very, very carefully about everything in your portfolio. And so that is the kind of exercise that I've been going through, that I think people need to really start looking at. Okay, what happens if I get inflation? If the CPI is at 4%, what does that do to my portfolio? And if you go through that exercise, you'll find, I suspect, if you've had a portfolio that's done relatively well over the last 10 years, it will do appallingly badly in an inflationary environment. So you need to be aware that that's a problem, and stress test your portfolio and take steps necessary to try and mitigate any fallout from that.
Okay, great. So now we're in the meat of it, and here come a whole ton of questions. The last one of which will be what's probably on the forefront of everybody's mind listening to your last statement there, which is, okay, what are some good investment categories for a high inflation future? But we've got a lot of people, I believe, in this audience who have been extremely skeptical of the incredibly distorted market valuations that have arisen from all of the central bank intervention into the markets over the past decade, right? Where multiples are at historic levels of distortion. Most asset prices are back up at near or at all-time highs at this point in time. And I think people have been saying, all right, look, that's been happening in parallel with the context of the global economy taking a historic blow. And at some point, it doesn't feel comfortable in many people putting their money into things like stocks right now, because they feel like, look, in theory, they should be based on earnings. And if earnings are getting hit, at some point, this stock price bubble that they believe exists today will burst, and they could lose a lot of money. So the problem is almost every other asset class has been similarly driven to high levels of valuation. So a lot of people have been parked in cash, right? Just waiting for lower valuations so that they can deploy their money at more historically sane valuation metrics. It sounds like what you're saying is they may be waiting for an event that doesn't happen, at least not in the next couple of years, if we're really shifting into this higher gear inflationary environment. Is that true?
Well, look, it depends. I mean, the one thing is that bonds are going to be a terrible place to be if we have an inflationary environment. So that's a horse that people have ridden to death for a long, long time. So everybody is stuffed to the gills with bonds, and they've really been making their returns on capital gains and not coupon payments, which just makes the jeopardy that much more severe. But if you look at the obvious place to go is commodities, right? I mean, if you think you're going to get inflation, goods inflation, commodities is absolutely the sensible place to go. And if you look at all the ratios of commodities to equities, and look at commodity producers versus technology stocks, for example, there are plenty of things you can do to cycle out of highly overvalued stocks that have had tremendous returns into other parts of the market, like commodities, that just haven't been loved for a long, long time, and offer value not only to a nominal appreciation in the stock market, should the markets just continue to go up because the inflation feeds through into stock market prices, as we saw in Venezuela, and everyone's championing the performance in the multiple thousands of percent of the Venezuelan stock market. But of course, the Bolivar lost value at tens of thousands of percent, so it didn't really help you. But commodities offer a chance to look at stocks that have been wildly unloved for a long, long time, and just put up the ratio of the Bloomberg Commodity Index to the Dow. and you'll see exactly where this thing lies. Take a
Yeah,
look
it's
at
basically at a historic extreme right now, right?
it's at 500-year lows almost. It's crazy. So that, that's a great opportunity if you believe that inflation thesis and you position for it and it comes. That will be a tremendous way to be positioned. Look at gold. Gold always does well in inflationary environments, and even though people will argue that it's still pretty strong, if you look at, again, gold divided by the S&P 500 or the Dow Jones, you'll see it's gone nowhere. I mean, it really hasn't gone anywhere. It's nowhere near the levels it got to versus the equity markets in the 1970s, when, of course, we had inflation. Inflation was the problem then. So look at what gold did versus equities between 1971 and 1980.
Right,
And you'll see the kind of potential. Yeah, exactly right. So there are all these things you can do, but the first thing that's so important is to sit down and think about the big picture and think what you expect is going to happen. And you haven't really had to go much beyond that for some considerable time now. Is the environment going to change dramatically? You go through the stress test, you ask yourself the questions, and the answer has come back pretty much no. I don't see anything that dramatically says the scenario is going to change. I feel, and other people feel, that now there is a credible chance that may change. And so you have to do the thinking once again, and you will probably find, if you do so, that the answer comes back, yeah, I need to think about this. And so, it's time to look for companies that actually produce hard assets. And talking about the gold miners in particular, if you look at the kind of shape that they've gotten themselves into over this last 5 years or so, well, actually 9 years since gold peaked in 2011, there's been a tremendous amount of repair work done to balance sheets of gold mining companies. And they're in much better shape now than they have been for a long, long time, just at the point where, gold is starting to show signs of life. And even if you look at the ratio of the gold price to the HUI index, the Philadelphia Gold Bugs Index, you'll see that, relatively speaking, the gold shares haven't really moved up in relation to gold. So once that confidence that we've changed the environment starts to feed through, once we start to see inflation, and once gold becomes a viable potential hedge for that, you will see the kind of money trying to get into what is a very, very small corner of the market, I suspect, send prices much higher. Institutions have had almost zero allocation to gold mines. I had a conversation with an endowment manager, a big endowment manager in the US a couple of weeks ago. He told me he's moved, for these very reasons, inflation fears, he's moved the gold allocation in his portfolio to 2.5%, which is a big move from essentially nothing. And he's thinking it's probably got to go to 5%. Now, if endowments in the US start allocating 2.5% to 5% of their investments to gold,
it's a game changer.
That will result. It will result in. I gave a presentation about this in 2015 called "Nobody Cares," which you can find on the internet if you're interested. And I went through the numbers as to what a reallocation to gold like that would mean for the market, and it's extraordinary. So that to me is the big thing that people need to wrestle with. Do you believe that inflation is going to be a problem? And don't think about it in the next 3 months, 5 months, 6 months, a year even. It's tough. This is a secular change we're talking about. Do you think over the next 5 years, over the next 10 years, that deflation is going to continue? Or if you put the piece of the puzzle together, you look at the response of central banks and governments to the pandemic, you look at what they've done in terms of money printing, you look at the situation the world's still in, and you understand that this is really the only option, no matter who wins the election in 3 weeks' time. Whoever comes in is going to have to print more money and try and keep this thing afloat. Does that suggest that inflation is going to be a problem over the next 10-year period? And I would argue that's a much better assessment, much easier assessment to make. And if that's the case, then if you want to position your portfolio for the next 10 years, it becomes a much more straightforward exercise.
Yeah, and straightforward exercises are the best ones, where you can pick a secular trend and ride a tailwind for a very long period of time, than trying to pick some sort of finite market window. So in many ways, what you're saying is quote unquote good news. It's not good news that we're necessarily going to be spending all the stimulus and entering into a high inflation environment, but for the prepared investor, that actually can actually be a pretty good thing if you've got more
Sure.
predictability going forward than you've had in the past. So Grant, just sort of summarizing what you said, it sounds like those people out there who have been waiting for this system to have a big, massive deflationary route as it breaks under its own unsustainability and kind of result in that blood on the streets moment where you're able to, pick up assets at generational low valuations. Sounding like, given where things are headed, the odds of that happening are less likely. And so rather than, keeping a ton of dry powder and waiting for that event that may never happen, sounds like, you putting words in your mouth here, but you would say, look to where the puck is going, look to more inflation. Already big, funds are already beginning to hop on board that bandwagon. Commodities are going to be one of those areas that's highly likely to benefit from that movement. And so look at getting access to hard assets and to those companies that produce hard assets. Is that relatively accurate?
Yeah, I think that's fair. And of course, the important point to make is that big deflationary bust is absolutely not off the table. It could absolutely happen. But again, that's a moment in time. The response to anything like that will be wildly inflationary. They will throw everything at that. And you may have to get through that. And that's why time frame is so important to understand. If you're trying to capture that deflationary bounce and then capture the upside, then A, good luck. I wish you all the best with it. B, it's a whole different mindset than it is to look forward and say, okay, I realize that between now and 2030, there could be a big deflationary bust, but over that 10-year time, I think inflation is going to be the problem. And if you position your portfolio and the deflationary bust comes, it'll be painful as hell. But as long as you're not fully invested, you still have some dry powder that you can add to those positions at that moment of crisis. That's an important thing to understand. So, the people who've been warning about this deflationary bust for some time, we haven't had the bust. We've had this persistent nagging inflation. And it doesn't mean that the people who've been talking about it and preparing for it have been wrong, because that entire time it has been a very distinct possibility. And at periods like now, the possibility has risen. The problem is if you've positioned your portfolio 100% for that deflationary bust, you've been carried out. But that's never a smart thing to do. Recognizing what the big danger is and having a plan to tackle it is the important thing here. And right now, with bond yields where they are, the debt levels where they are, and the business cycle where it is, inflation is the big danger. So you need to have a plan for it.
All right. And, one of the things that we say very often at Peak Prosperity here is make sure that you're working in the partnership with a financial advisor that understands the types of risks and has a similar concept of or grasp of the macro view, like Grant's mentioning here. For most people, trying to go it alone, very hard to do, both in terms of the planning, but definitely the execution. But our strong recommendation is find somebody who's like-minded, who can be watching, the markets very closely for you and helping you put together a good plan.
It's very important. And I would say, and I hate to be ageist, but if you can find a financial advisor with some gray hair on his head who understands these things, because if you've been in the markets for less than 35 years, you have no experience of inflation unless you've read about it in a book. So it behooves you to talk to people who are going to manage your money and ask them these questions about inflation. Ask them what their plans are for that change in the environment. Because if you find that they really don't have a plan because it's not something they've ever had to countenance, there's no shame in that. They haven't had to worry about it for their entire careers in many cases. But for you as the owner of the assets, looking for someone to look after for you, you have to make sure that whoever's doing that has a broader grasp of the potential outcomes than what's happened over the last 20 years.
Yeah, that's a great point, Grant. So you talked earlier about how, bonds are going to finally be a bad place to be, where if you've, been in the bond market for the past 20 years, you've had this massive tailwind at your back, right? So to your point, like the musculature of most financial professionals has been developed for an era that it sounds like is maybe ending here, right? And so to your point, and I don't think it's an ageist point, I think it's just a practical, realistic point. Try to find somebody who's got some experience from somewhere in their career of actually dealing in an inflationary environment. All right, Grant, I want to shift here as we get into the last couple of minutes of this conversation, because I know you're a thoughtful and very conscientious guy. So on the path from the great financial crisis to today, with the way that the central banks have been supporting the markets, and particularly since the coronavirus happened, and their intense support of the markets, um, that has really exacerbated income equality or wealth inequality in this country, really around the world, but we particularly are
Yep.
seeing it here in America. Um, and you know, with more stimulus to come and an inflationary environment, that's only going to make the situation worse, right? So you're going to have, to the extent that financial assets keep going up and are continue to be supported by more stimulus, it makes the rich even richer, while the bottom 99% of people are still unemployed. Maybe even, you know, future job losses are still ahead of us. So the situation will get even worse. Obviously, in a high inflation environment, that means higher cost of living, right? So they don't have a rosy outlook for their incomes, and their expenses look like they're going to be, you know, growing more quickly going forward than they have to date. And they've been growing pretty badly to date, especially in the essentials like healthcare and whatnot. So where I'm going with this is kind of how do you see this resolving? You know, clearly, if you look at the current trajectory, it's not hard to come to the conclusion that social rest is going to continue, maybe up until the point where there is some sort of real sort of revolution, you know, some sort of real rebellion against what's going on. Is there a way to avoid that, or do you think that kind of unrest is inevitable?
Well, look, I think there have been people talking about this kind of unrest for quite some time, and they all sounded like doom mongers for the longest time, until you start getting videos of you know, the protests that swept through America earlier this year, and whatever the cause, it morphed and it metastasized into something much deeper. A lot of those protests, and so, you know, what you have to remember is that the 99%, give or take, have 99% of the votes also. And so we're reaching the point now where they are much more activated. They're much less likely to be content to be told they've never had it so good, because post-pandemic they can feel they're struggling. They've lost their jobs now. So what's going to happen, I suspect, after the election and for elections to come, I suspect for you know, a number of years, whether they be midterm elections or presidential elections in the US and the UK and elsewhere, you are going to start to see politicians necessarily play much more to Main Street than Wall Street, because your point is absolutely correct. The income inequality is shocking. And no matter what the Federal Reserve said, and shame on them for denying it, but it can be traced directly back to their policies. And it's not a complicated set of dots to join. There's probably 2 or 3 at most. So I think governments are going to get more active and get more populist in terms of their stimulus efforts, and try to drop this stuff into people's bank accounts directly. What happens then is anybody's guess. I mean, we've seen saving rates spike with, you know, a lot of people are earning more now thanks to the government than they were before they got fired over the pandemic or laid off. And we've seen, surprisingly to many people, we've seen savings rates go up. We've seen them use that to pay down debt instead of going out and spending it, which is great for the personal balance sheet. It's not great for the economy. And it just suggests that they will have to keep pushing on that string and dumping more money until people can get comfortable with the stimulus that they've got coming from the government being enough for them to repair their own balance sheet and go out and spend some. I don't know what that number is going to be, but this, I suspect, is what is going to happen going forward on a political basis. It's very difficult for the governments now around the world to step back from the measures they put in place with regards to lockdown and regards shutting down economies without essentially admitting that they've screwed this thing up. Admitting, saying that you know, we shouldn't have closed the economy, we shouldn't have done this, we shouldn't have done that, we should have handled it differently. And sadly, there isn't a politician in the world that's going to make that admission, no matter how accurate it is. They're just not going to do that, because given what's happened and the depths of the pain being felt by people, if you've got people by the millions losing their jobs, and you as a leader come out and say, do you know what, this was on us, we handled it badly, we're going to reverse that, you're not going to get voted back in for a generation. So this whole thing now is going to become a game of politics, and with that income inequality and people starting to wake up to just what's happened in terms of the rich getting rich, and all the calls for taxing the rich, and in some cases getting the guillotines out for the rich, this is becoming a very real problem in America and beyond. And politicians, to cater to that, are going to have to be seen to take away from the rich and give money to those who need it more. So I I feel very confident in predicting that that is the way this is going to go.
All right. Well, very well said. All right. So last question for you as we wrap up here. Where, if anywhere, do you see the hope in this story?
Well, look, I think we as humans are incredibly resilient. If you look at what's happened since the pandemic, whether it's working from home, whether it's businesses that have done really well, whether it's people finding ways to homeschool kids or whatever it may be, there are solutions that are being found to particular problems. Ultimately, this is a big failure of the financial system, is what's happened here, and that needs to be reset, and it's needed to be reset for some time now. Without the pandemic, I suspect that reset would have taken longer and been more drawn out, more painful, and more like the tired old boiling frog cliche. But what the pandemic's done is, I suspect, brought that reset forward. And as painful as any reset is, and you can read about plenty of them over time in history, there's always something great that comes out of them. You know, I've been reading this again recently, Neil Howe's book, The Fourth Turning.
Neil Howe, yeah, that's a wonderful book.
Third time I've read it. But in reading that, two things become apparent to you. One, how bad and how painful the fourth turning is, which is where we are right now, but also how hopeful and how optimistic the next first turning becomes. So, mankind will get through this. There's no doubt about it. It's not going to be the end of mankind, and there will be an awful lot of positives to come out of it. The trick is understanding the danger level, which is high, significantly high now for many reasons, having a plan to deal with it, and really understanding that when you get a real bear market, the like of which we haven't really seen for a long time now, we've seen crashes, we haven't really seen a bear market. But in periods like this and in times of reset, everybody loses. The trick is to try and lose less than other people, and that requires being thoughtful and being prepared. It's really no more complicated than that.
One of the things I love about you, Grant, is just sort of how like-minded we are, and I oftentimes hear you using terminology that we use ourselves, and it's just such a wonderful validation from such a great mind like yours. So that last comment about be prepared to lose money. The trick is just trying to lose less than everybody else. That's a piece I've actually written before and used many times in our presentations. And I think with the insights that you've shared here today, both on the macro side, but also giving people some concrete areas to look at for where to invest in a higher inflationary environment, I think you've done folks a good service here in giving them some really good territory to explore in helping them hopefully lose less money than everybody else as we go into this sort of the darker parts of the fourth turning that we've entered into. So with that, I'm going to let you get back. Thanks so much for taking the time. I know you're piping in here with us from the Cayman Islands, so I appreciate you doing an international face-to-face here with us. And Grant, as always, it's just such a pleasure.
Always a pleasure. Adam, thanks for having me on, and give my regards to Chris, won't you?
What an unbelievably good interview, and just what a great guy. Grant is such a class act. So as I mentioned at the beginning of the video here, Grant's interview was just one of over 24 that were made available through the Peak Prosperity Seminar, How to Prosper in the Post-COVID Future. It was an amazing event. We had over 1,000 people watch the event live, and I just got phenomenal feedback. And anyways, if you're interested in seeing more clips from the event, just go to peakprosperity.com/recap2020. Again, just a phenomenal roster of speakers. In addition to Grant, we had Mike Maloney, Chris Martenson, Sven Henrik, Danielle DiMartino Booth, Axel Merck, John Rubino, Charles Hugh Smith, Wolf Richter. We had experts on money, investing, real estate, investing in farmland, just a whole host of very key high interest topics on the money side of things. And that was just day one. In day two, we had a whole host of other experts on all other elements of wealth in your life, because money is important, but it's only a component of wealth. So things like how to be more resilient, how to have a more energy efficient home, how to protect yourself from growing social unrest, how to make yourself healthier, how to grow food more healthily. We had America's farmer, Joel Salatin there. Just a whole host of other great experts. And again, we've got a number of free clips that you can watch at peakprosperity.com/recap2020. 2020. So go there when you've got a few extra minutes. Okay, so now John and Mike, time for our weekly recap here. Before we talk about the markets though, I'd love to get your guys' initial reaction to what Grant just said. So obviously one of the big takeaways from that presentation was Grant's realization that we do really seem to be converting from a multi-decade deflationary trend into a secular future trend of higher inflation. And he talked about some of the key deflationists who have been, on the deflation bandwagon again for 40 plus years, who are now beginning to switch teams. So that's so important because it's a very different investing playbook for inflation versus deflation. And I know we have a lot of people who are watching this video who concerned about a deflationary correction or crash in the markets have been just sitting in cash and waiting for some sort of big correction to then be able to deploy their assets at better valuations for. Some people kind of refer this to the blood on the streets moment. And Grant didn't say that it's still not going to happen, but he said the probabilities of it are decreasing. And so you really got to be nimble here as an investor. And you want to be, making sure that at least a material chunk of your portfolio strategy is now positioned to do well if indeed we are entering into an inflationary future. So anyways, first off, he talked about things that might do really well in that type of world. He talks about, commodities, hard assets, the companies that produce them, bonds, which have just had a steady tailwind for the past several decades. He now thinks are potentially going to be a bad investment going forward. And I guess just sort of key advice is like, don't position your portfolio 100% for any one eventuality. That comment that we talked about at the end, in this type of crazy environment, which we've long said is one of the most treacherous investing environments, in our living lifetime, says you got to be prepared to lose money. The trick is just to lose less than everybody else. So with that backdrop, guys, what else did you take from Grant's comments?
I guess I'll start, Adam. We thought he had a lot of great comments. He mentioned a couple of deflationists in his talk. Russell Napier and Lacey Hunt, both of them have been prominent deflationists. Russell Napier, as he points out, has converted over to the inflation camp, and Lacey Hunt, at least somewhat, has said inflation will happen if the Fed monetizes their balance sheet, which there's been some talk of. Here's the thing that's difficult for any portfolio manager, though. Yeah, we agree that the risk of inflation is certainly heating up in the long term, but you do kind of have to make a call in the near term about what you think is going to happen, because there really is no way to have everything. You can't have your cake and eat it too. We still think that deflationary forces are prominent in this economy, in this market, and that's what the Fed has been fighting against all these years. We agree that commodities are the place to be, and that commodities are woefully undervalued relative to the rest of the S&P 500. That's why we like gold, silver, gold mining stocks. We also like oil and gas stocks. That whole sector is looking pretty attractive. But we can't really put 100% of one's money into that sector, nor should I say anyone should. We still think that if we move from relatively stable inflation like we have now into hyperinflation suddenly, history shows that that'll be very bad for the stock market. The stock market will likely crash first, then maybe long-term go vertical. Same with deflation. If we go straight into strong deflation, the stock market will get hurt badly. So whenever you move from stable inflation to either real rapid inflation or rapid deflation, assets are going to get hit. So as hard as it is to sit in a relatively high position of cash waiting for better prices, that still is what we're predominantly doing. We've got about 2/3 of our assets in treasury bills, cash equivalents, and we're looking for better places to invest. We completely agree with so much of what he says, that the Federal Reserve and other central banks are all in, that what they're doing is not stimulus, it's maintenance. It's ridiculously unstable. We sit at the highest valuations ever in U.S. history as we speak right now. We don't think there's any way that we get out of this without some type of jiggle or better buying opportunity in the time ahead. Even if we go right into hyperinflation, we think there's a better buying opportunity. So there's just a couple thoughts off the top of my head.
Well said, Mike. And as one of the other presenters from the seminar, Axel Merck, said, inflation isn't like don't think of it as like a constant wave. He said it sort of pops up sort of here and there. So it's very episodic. So to your point, you can have an inflationary trend, still punctuated by periods of deflation. So again, that's sort of, I think why Grant was saying, don't be 100% positioned for any, one potential eventuality. You've got to have enough flexibility to be able to sort of play to, the longer term trend while remaining nimble enough to react to or defend against, shorter term counter trends. John, anything else to what Mike said there?
Yeah, no, I'll add a couple things. We totally agree. For example, Grant talked about the concept of rotation out of certain types of assets that maybe have had a tailwind at their back, maybe on a premise of inflation, or at least not inflation. And to the extent that inflation takes more of a kind of root, that there'll likely be a rotation into things like commodities and things like that. And that's, for example, we have what we refer to as a spread trade in our client portfolios right now, where we're essentially have a longer bias towards foreign emerging markets equities stocks versus US stocks. And emerging market stocks are heavily tilted towards things like commodities and energy and things like that. So not to mention just the currency diversification, I suppose. So we like emerging market stocks, for example, even better in an inflationary type environment. But as we start to look at in the context of this hyper overvalued market, we start to look at opportunities perhaps to look at more of these kind of spread trades where maybe we go long or get positive exposure to some more natural resource type stocks, basic materials, the coppers, the iron ore, the basic chemicals, things like that are commodity driven. We go long those, but perhaps we balance it off with some kind of inverse exposure to some of the sectors that have done well in a premise of disinflation. We also, certainly in the context of the overvalued market, when we start to toe dip, as we're considering, we're constantly talking about what ideas or what plays might make sense for our client portfolios. We always got to remind ourselves that we have these great hedging tools in the form of options that we are very skilled at using. And it's not, there's no free lunch in markets or life in general, but options are a great way to kind of have some insurance policies in place so that we can start to toe dip in some key sectors that we think will have some tailwinds, but at the same time not be completely at risk for a massive sell-off, which is long overdue.
Yeah, so two things. One, I just want to put up a chart that I put up 2 weeks ago during our interview with Jim Rogers, but just to give folks a sense again of how undervalued commodities are relative to the S&P and the general stock market indices, just historically low valuations. And of course, buy low, sell high. You want to buy into these sectors when they are priced low on a relative basis. And then, of course, everything Grant mentioned, is going to act as likely a tailwind to that sector. So, definitely sort of seems like a good time to be buying in. The other thing that Grant said was that, he said you want to look for an advisor to work with who's got some gray hair, because very few, brokers, financial advisors, et cetera, in the industry have ever invested in a secular inflationary environment. All they know has been the secular deflation that's been going on the past couple of decades. And real quick too, just a quick aside for folks, because our guest last week, Glenn Kacher, mentioned this. He was talking about tech being very deflationary, and people oftentimes say, "What are you talking about? The fact we've been in a deflationary trend? Prices have gone up a lot over the past couple of decades." It is true, but if you look at sort of what's been driving the economy, it's largely been a decrease in the cost structure of how business is being done. And that's, if you think of technology has really reduced the operating costs for many, many different industries. And that is a deflationary trend. As we begin to go into inflation, of course, that trend that we've been accustomed to is going to play less and less of a factor going forward. And that's sort of what we're talking about here. But anyway, so John, as you mentioned, or as Grant mentioned, ideally you want to work with one of the few people kind of left in the industry that's got at least some experience here. Now, you guys aren't, you're not the grizzled 70-year-old market veterans, but you do have some white around the temples. Can you just comment on your guys' ability to handle indeed a secular shift here, if indeed that's what's occurring?
Well, maybe given the fact that I have more gray hair and less of it as compared to Mike, I'll take the first cut at that. But here's the thing. So I'm 50. Mike is essentially the same age. We're still got plenty, hopefully, years in our careers. But we're driven by data. And the great thing about data is we can go back and look at data for years that vastly predate our existence, frankly. And from that, we can kind of essentially live through those prior cycles, whether we were on this planet or not. And that's exactly, where we can kind of look at things and conclude, for example, that historically speaking, the first impulse of an inflationary move, especially when stocks are overvalued, does usually translate to a massive, pretty notable sell-off in those stocks, even if longer term, those stocks might be a good inflation hedge. And that's where we get our tenure, if you will, by being tethered to data.
Great. Yeah. And you also mentioned too, that you guys have a lot of experience. In fact, this is sort of a primary reason why we formed our initial relationship with you guys, was because of your risk management expertise in using options, not to speculate, but to, arm portfolios with downside protection. And, heading into the type of future that Grant sort of mentioned, having that sort of mindset to defend against risk is super important, whereas we all kind of know the average broker that's out there, stock advisor that's out there, basically just says, look, the market's going to take care of you in the long run, just be 100% invested, 100% long all the time. And I think, Grant would say, that type of approach is just going to be the complete wrong approach going forward. Mike, well, real quick, I want to shift to the markets and what they've done since we met last week. Why don't you give the recap? I mean, there's been some ups, there's been some downs, there's been some crazy days. What are you seeing so far?
Well, there's a few, kind of indices that we look at pretty regularly, the same ones that most people look at. And I just, each week, just make a note of what's happened over the last week since we talked last. We usually record on Thursday, so we're looking back a week to the previous Thursday. So the S&P at the moment is up about 50 points relative to last week. Of course, shot higher than there on euphoria Monday morning, both on a resolution in the election and some positive clinical trial data on a COVID vaccine out of Pfizer. It's got all the looks of a blow-off top again. I mean, this has been a pretty ridiculous market. Depends upon how you count them. Probably had at least 8 blow-off tops in the S&P over the last 3 years. I know we keep saying it, but the market looks to be trying to put a top in since January of 18. So almost 3 years now. We topped out back in January of 18 at around 2,900 on the S&P. Here we are at 3,550, maybe about 20% maximum higher from there. The market has continually tried to correct, and it's continually been rescued. We have not had a real bear market in really 12 years. Every pullback, even though it's been greater than 20%, has been instantly rescued. That's what happened in March. So the S&P is sitting right here, right near its all-time highs, up about 50 points relative to last week. We'll see what happens with Friday's close, but this week looks like a little bit of a euphoric kind of shooting star, if you will, where we went up and then so far reversed off that high. Gold miners are gold and gold miners are down this week. With the euphoria that we saw in the equities markets, we saw a sell-off in gold. Unfortunately, gold was down about $100 per ounce on Monday, and gold mining stocks, as measured by GDX, the ETF are down about $3 relative to last week's level. Incidentally, we have hedges on our gold mining position, which is right at roughly the level we're at here. So over the next week or two, if we see any further downside pressure, we've got really good insurance on the downside. Volatility came off pretty strongly in the last week, about 4 points or, a good 10%, as tensions eased. And I guess, some uncertainty came out of the air, but volatility still remains relatively high. VIX is, up in the 20s, which is not low by any means. So it's still a pretty tense market. And I guess lastly, we look at bonds. There's been a pretty good move in bonds here too over the last week. Bonds have started to sell off, and yields are starting to poke up out of long-term consolidation ranges. The 10-year Treasury bond was 0.76 about a week ago. It's 0.92 right now. So it's knocking on the door of the even 1% as overhead resistance. And I think Grant said there, the real risk is inflation and rising yields and a sell-off in bonds. And I don't really think that many people are talking about the creep up in yields here. And so it's something that could become as a surprise to the market. This is overall a very, very tense, completely overvalued market that is only reliant on the maintenance of central banks. We don't think it's sustainable. And we'll keep watching.
Yeah, and it's crazy that an almost 1% yield on the 10-year is like worth commenting on, is like, wow, rates are going up. I mean, just it's so low looking at it with a historical perspective. Yeah, and so I mean, what you seem to be observing there, Mike, is that the election's over, and we had the really positive news from Pfizer on the vaccine trials. And so it seems like a lot of sort of perceived risk and uncertainty is coming out of the market. And that's, probably likely why the VIX is down, and also why the precious metals are down a bit, right? Because they're a bit of a fear trade. But what's so interesting is, as you said, Mike, that there's all sorts of reasons to still remain concerned here. One, I just looked at the initial jobless claims today. So initial jobless and continuing claims are down, right? That's the headline that everybody is, cheering. But if you look at the data, there's still 20 million people that are receiving jobless benefits. And really, yes, initial claims and jobless claims and continuing claims are down. But the number of people that are receiving pandemic extended benefits is rising. So really, it's not that that number is going down of jobless claims because people are going back to work. It's going down because people are being reclassified into the pandemic program. And that's where the largest amount of people that are receiving government support are now. And I'm putting up some charts here to show that. So, we still have a massive problem with this economy. We've taken tens of millions of people who are working at the beginning of January and ripped them out of work, and there's no roadmap yet for how we're going to get those people going back to work. And the world has kind of changed, right? I mean, a lot of people have realized that they can work. A lot of companies have realized that they can work with either smaller workforces or remote workforces or whatnot. And so, there's a huge assumption that everything's going to get back to normal at some point next year when the vaccine arrives. And I think that is still really up in the air at this point. And just what we're seeing in stocks here is, as the stocks have been going up, particularly in this past week, you've actually seen the work from home darlings get hit because everybody's excited that the vaccine is going to let everybody go back to normal. And those companies won't benefit as much. And there's a rotation into other different sectors. And I'm looking at the Russell, which is basically the smaller cap stocks out there. And that thing is back to near all-time highs. And it's like, what planet are we living on, right? The economic growth is still a fraction of, or the GDP is still very impaired to what it was before. There's still a good chunk of those companies that are going to be very impaired going forward. And a good chunk of them are probably not going to make it, right? And yet we're still back up to all-time highs on it. So it does very much, to your point, Mike, just seem like we're back to sort of crazy town here. John, I'll let you have the last word here before we break off.
Just to add on the Russell there, I mean, prior to this whole COVID thing, and it was well documented, well observed that the percentage of companies in the Russell 2000 that are not even positive cash flow was at kind of multi-year, if not multi-decade high. So the underlying company health, even without COVID, was pretty suspect to certainly not justified to get the valuations that index had then and has now, frankly.
Yeah, and I think part of the enthusiasm was, okay, Biden's going to win, and there's going to be a blue wave, and it's just going to be more and more stimulus for everybody. But, and of course, they're still recounting the votes. It does seem at this point in time that it's going to be a divided Congress, which I think you can make a credible assumption that there's going to be less stimulus than there otherwise would be, given that that schism there. And so it really does seem very head scratching to see, these smaller cap companies go off to the races like this. But anyways, this is the type of insanity that we like to flag for folks to say, hey, as long as we're seeing signs of craziness like this, we do not think that this is a safe market to be, getting optimistic and excited about. All right, guys. So with that, we'll wrap up for this week, and look forward to talking to you guys next week. But as we close here, a couple quick housekeeping notes as usual. First off, again, if you didn't watch our seminar, go check out peakprosperity.com/recap 2020. You'll see a number of clips from the presentations there. It's all free. And then if you're interested in actually getting access to the entire event, you can do so from that page. As always, I let folks know on my Twitter account who we are lining up for future interviews here, and I'd love to get feedback on guests that you'd like to see going forward. So if you haven't yet, follow me on Twitter at @MenloBear. If you haven't yet as well, please click on that like button. It just takes you less than a second, and believe it or not, the likes actually do matter in terms of how much YouTube will share these videos, so please do that. And then lastly, as always, if you haven't yet, and why haven't you, schedule a conversation with the guys here at New Harbor, with John and Mike and the team there. They offer a completely free portfolio audit with a look at all your financial investments in the light of the different risks that Grant and they have talked about on this interview. It's completely free. There's no commitment to work for them. It's just a public service that we've worked out with them for the Peak Prosperity audience. And even if you've talked to them, say you talked to them a year or two ago, the markets have changed a bit. It wouldn't hurt to reach out and just have another conversation with them. Again, totally free. If you're interested in learning how to do that, it's very quick. Just stick around to the end of the video here and we give you all the instructions on how to do it. So John and Mike, great conversation as usual. Again, Grant Williams, just another great guest. I'm really excited and happy about the very high quality of guests that we've been getting on this program. And we've got lines out with some other guests that are at just as high a level of impressiveness, if not even more. So I'm not going to mention who they are. We'll surprise folks when we come on next week. And until then, guys, I'll see you in a week.
Thanks, Adam. See you soon.
Thanks, Adam. We'll see you soon. Bye now.
If you'd like to schedule a consultation with the financial advisors at New Harbor Financial, simply go to greylockpeak.com. These consultations are completely free and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given the latest market outlook. They're willing to do this because they care about protecting people's wealth and because Peak Prosperity has connected them with so many thoughtful investors just like you over the past decade. Chris and I started doing this because so many people have approached us in frustration and are looking for a solution because they're feeling out of alignment or just downright ridiculed by the standard sort of financial advisors who have been managing their money. You know the type, the kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, don't worry, the market's always going to take care of you. For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing, which is why we strongly believe that today's investors are best served working in partnership with a conscientious professional advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, just as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you aren't, or you're having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. And for those about to ask, yes, there's a business relationship between Peak Prosperity and New Harbor, which we had to put in place to make sure that everything is handled according to SEC regulations. All the details on this are clearly provided on the greylockpeak.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to greylockpeak.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.